afternoon, everybody. This is a snapshot of the portfolio as it stands at the end of the 6 months. Certain of the items I'm going to discuss in more detail later on, but I'll go through. The asset value, as you know, 19 billion. The valuation per square metre and the average property value will both increase as we succeed with our strategy of acquiring higher grade properties. Number of properties, 243. It's down from over 400 at the time of the Apex High merger and from 300 odd last year. Total GLA is just under 3 million square metres, and you can see the split amongst the office, retail and industrial. The vacancy is just under 200,000 square metres and at the moment sits at about 6.6%, and I'll go into that in more detail. The average, the renewal success rate sits at 83%, which in this market is particularly high. The average renewal rental growth at an average of 4%, which we're reasonably happy with. We believe that there's some growth to come from the industrial sector and certainly in certain areas of the office sector. The average gross rental, 68 Rand a square metre. Again, we believe that the office average rental could be higher. It's at that level primarily because of the government holding. The average rental for retail, we believe there's room for growth. We think that given the industrial portfolio, 33 Rand a square metre gross is probably realistic in these times. Average escalations just under 8%. And then the property expense ratio, as has been discussed by Andrew before me. The top 10 properties by value. Golden Walk, you know, very successful centre in Germiston. Discovery, which we acquired last year. Standard Bank Centre in Cape Town, we're due to do a redevelopment, and again I'll discuss later. Sammy Mark Centre, we bought the third portion last year. We've already seen growth in the net income over and above what we anticipated. Tybalt Square, subject to a 3-year head lease from Zemprop. Convention Centre, Cleary Park, Commerce Square, again property we acquired last year. Park Meadows, which Mark discussed earlier in terms of the Food Lovers Market redevelopment, and then Poynton's, a property that we've earmarked for sale. Okay, we've said previously that we wanted to try and achieve a ratio of about 30 to 35% of the portfolio in single tenanted buildings. We're at about 30% at the moment, and so pretty much on line with what our strategy has been. The portfolio sectoral spread, well, the exposure is approximately 50% to offices, and 50% of that exposure is really to properties within the Johannesburg, Pretoria and Durban CBDs. They're properties that in the midterm we will sell, certainly sell 50% of them, and that will obviously have a very positive impact on our exposure. Out of interest sake, in our strategy we said that we wanted to acquire retail properties of no less than 15,000 square metres. Of the just under 7 billion Rand in value of retail, 20 of such properties we hold, and that's about 50% of the total value. The geographical spread, pretty much in line again with what we strategized. We said that we wanted to be invested in KZN, Western Cape and Gauteng. We are invested above 90% in those areas, and that will be pretty much the same going forward. Sector vacancy. And what I've done here is we removed certain properties which in our opinion are unlettable, and it reflects a vacancy level of 6.6%, and the properties are buildings such as 320 West Street in KZN. It's excuse me, it's an old building in West Street, 25,000 square metres of vacant space. It's unlikely that we would ever let it. The cost of letting the space would be prohibitive, and so in order to be realistic, we've shown we've taken that out. Likewise with the Trust Bank building, Poynton's in Pretoria, and a building called Pico, which sits in Bethel. Out of interest sake, if we were to let the 200,000 square metres of vacant space at market-related rentals, there's probably an opportunity to increase the distribution by between 4 and 5 cents. Again, a lot of information on this slide, but let me take you through it. We've started with the vacancy at the end of last year. We removed the unlettable building vacancy and we removed it from the GLA. There are adjustments which will take place on an ongoing basis as one remeasures properties, etc. There are buildings that we've demolished for redevelopment. Then there are the acquisitions and disposals, giving a total of 178,000 of vacancy and about 6%. Then we've shown is the lease activity for the 6 months. So we've shown that there were 464,000 square meters of GLA that came up for renewal. We renewed 384,000 of that, and I've included in that monthly tenancies, which is about 83%. So tenants vacated just about 80,000 square meters, early terminations of leases just over 60,000, and then new lettings of about 123,000. So as we stand at the end of the 6 months, a vacancy level of 6.6%. Then the actual activity for the 6 months essentially shows the area renewed, the rentals at expiry, and the renewal rentals, and the 4% growth that we talked about earlier. I think it's important here to know that there were some big swings and roundabouts. For example, the Accenture lease in Woodmead and the Alexander Forbes lease in Rivonia were done at significantly lower rentals than at expiry. And then there were some big uplifts in terms of Emanzini and Parliament Towers, buildings occupied by government. These are currently the major leases under negotiation between now and the end of the financial year. As you can see, not a lot of large leases remaining. The majority have been achieved. There's approximately, well, there's 15 billion rands worth of monthly rental that's been renewed during this period, 230,000 square meters. I think what's important to note is that apart from the major swings, those that have a monthly alongside essentially are the government leases, the leases that have been renewed. Regrettably, in terms of the current government dispensation, all leases now get signed off at the DG's office. We think that could take a while. I'll give you an example. We negotiated a lease last year for 3 years. It took 18 months for the lease documentation to arrive. Again, the lease expiry profile. Last year, you may recall, we had approximately 900,000 square meters of space to renew. At the half year, that's down to 350, and 160,000 of that essentially contains the monthly leases, and you'll see I've listed the 6 at the bottom, which in total is 104,000, which is the majority of the office monthly leases. For next year, there's 760,000 square meters to be renewed. I anticipate that by the end of this financial year, that will certainly be under 500,000, which will be within the 20% that generally one tries to set for oneself. Okay, acquisitions. Those are the 5 properties acquired during the period: the Discovery Building in Sandton, the General Motors Centre in Kucha, Tybal Square in Cape Town, which has the head lease, 22 Fredman Drive, which is the Eversheds property in Sandton, and then UTI, a smaller property out of a portfolio. Acquisitions after Feb. The first 4 properties, industrial properties that we acquired from Improvon, they were transferred end of March. The remainder of the industrial properties are properties coming out of the Zemprop portfolios and Improvon, other than for Dawn, which we've acquired 50% from an individual. Chris Hani Crossing is the dominant shopping centre in Vosloorus. We managed to acquire 50% of that, and it's in line with the type of retail centre that we're looking to acquire. South Coast Mall, you've probably read about. We acquired the Hyprop stake of 50% at a particularly good yield, just over 11%. Bricker Road, and then the bottom properties are the Nickel Grove portfolio, which will come from Zemprop, hopefully by the end of the calendar year. And then disposals, 104 properties. As you can see, small properties, just under 500,000 square meters in total, quite a large vacancy proportion. And that's disposals post February. Shoprite Eloff Street, interesting story. Took 18 months for this property to be transferred, primarily because the 2 water meters that serve the building, council were unable to find one. They disallowed us from finding it for them. Took them 18 months to rectify the issue. Finally transferred. The following 3 retail properties are properties sold to Arrowhead. They're properties which have head leases, and we are in the process of trying to get consent to sell those properties. And then a number of smaller properties, and then the industrial properties are part of the Arrow Creek portfolio. Okay, then developments. These are the current developments underway at the moment. Pepkor, Mark alluded to, you're aware of that. Scania, 90 Grayston, Rotenbach Street in Roslyn is a new distribution warehouse. We're doing a 50-50 agreement, or we've come to a 50-50 agreement with the JD Group. Alberton Mall, a small reconfiguration of what has been very difficult retail space to let. And then the others I think have previously been discussed. Then future developments, there's 90 Rivonia, again discussed earlier. Sturdy Avenue in Rosebank. We hope to conclude an agreement with a large corporate to do a 50-50 development of approximately 40,000 square meters. Tabatsi Mall and Motlasana are 2 retail shopping centres we've acquired. They're both subject to 66% of the GLA being let to tenants acceptable to ourselves, plus SDPs in place by the end of June, and we'll decide at that point in time whether or not we take these forward. Standard Bank Centre in Cape Town, the intention is to build a deck of parking and to put on new facade to the building. Ottery Hypermarket, we're waiting the approval of application for 8,000 square meters of additional retail rights. And then One Tybolt will be probably an improvement to the parking ratios in time. And then completed developments, the Food Lovers Market in Park Meadows has been an absolutely outstanding opening. I think it was the highest turnover in the first week that they've done in any of their new stores. Mimites Road has now been complete. Kopanong development for Shoprite, again, very successful. We're now looking at whether or not we shouldn't do phase 2. Shoprite Paro, discussed by Mark, and then CTX Business Park, completed a few months ago. Thank you very much.